Hey everyone, welcome back. Today we're diving into the fascinating world of IPOs, what they are, why companies go public, and how it all starts. Let's break it down. It stands for Initial Public Offering. It's like a coming out party for a company's stock. Before an IPO, a company is private. Think of it like a small business owned by a few people. When it goes public, anyone can buy a piece of it. Why go public? One word, money. IPOs let companies raise huge amounts of cash. They can use this money to grow their business, pay off debts, or even buy other companies. It's like leveling up in a video game. Going public isn't just about the money, though. It's also about prestige. A public company has more visibility and credibility. It's a sign that the company has made it. But going public is a big decision. It's not for every company. It's a complex process with lots of rules and regulations. But for the right company, it can be a game changer. So how does a company even get to the point where it can go public? It all starts with an idea. But ideas need money to grow. That's where angel investors come in. Angel investors are wealthy individuals who invest in early-stage companies. They're like the cool aunts and uncles of the business world, willing to take a chance on a promising idea. They provide what's called seed funding. Seed funding is like the first watering can for a tiny sprout. It helps the company get off the ground, build a prototype, and hire a small team. It's a risky investment, but the potential rewards are huge. Angel investors don't just provide money, though. They also offer valuable advice and mentorship. They've been there, done that, and they can help guide the company through the early stages of growth. Think of them as the wise mentors in a superhero movie. If the company is successful, it will eventually need more fuel to grow. That's where venture capitalists or VCs come in. VCs are like the big brother of angel investors. They have deeper pockets and a higher risk tolerance. VCs invest in companies that have already shown some traction. They're looking for businesses with a strong team, a proven product or service, and a large potential market. They provide funding in rounds, starting with Series A. Series A funding is like strapping a rocket booster to the company. It helps them scale up their operations, expand into new markets, and hire more employees. VCs are looking for a big return on their investment, so they're very selective about the companies they back. VCs also play an active role in companies they invest in. They often take a seat on the board of directors and provide strategic guidance. They want to make sure the company is on the right track to achieve its goals. Section 4, banks and debt building for the future. As the company continues to grow, it may need even more capital. This is where banks come in. Banks are like the construction crews of the business world. They provide loans and lines of credit that companies can use to build factories, buy equipment, or hire more employees. This type of funding is called debt. It's different from equity, which is what angel investors and VCs provide. Debt is like a mortgage. The company borrows money and agrees to pay it back with interest over a set period of time. Debt can be a powerful tool for growth, but it's important to use it wisely. Too much debt can be risky, especially if the economy takes a downturn. Companies need to find the right balance between debt and equity financing. This is where the concept of CAPEX comes in. CAPEX stands for capital expenditures. It refers to the money a company spends on fixed assets, like buildings and equipment. Banks often provide loans to finance CAPEX projects. Section 5, private equity, the pre-IPO powerhouse. Before a company goes public, it may attract the attention of private equity or PE firms. PE firms are like the private jets of the investment world. They manage massive funds of money from wealthy individuals and institutions. PE firms typically invest in mature businesses that are already profitable. They may buy out the existing owners or take a majority stake in the company. Their goal is to improve the company's operations, increase its value, and then sell it for a profit. PE firms are known for their financial engineering skills. They often use debt to finance their acquisitions, which can amplify their returns. They also have a team of experienced operators who can help improve the company's performance. PE investment is a sign that a company is on the fast track to an IPO. It means the company has a proven track record, a strong management team, and significant growth potential. It's like getting a stamp of approval from the Wall Street elite. Section 6, Ringing the bell, the IPO Launchpad. Finally, the moment we've all been waiting for, the IPO. The company has gone through all the stages of funding, from angel investors to private equity. Now it's ready to go public and share its success with the world. The IPO process is complex and involves a lot of paperwork and regulatory hurdles. The company will work with investment banks to determine the offering price of its stock and to market the IPO to potential investors. On the day of the IPO, the company's stock will begin trading on a stock exchange like the New York Stock Exchange or NASDAQ. This is a major milestone for the company and its founders. Going public is not the finish line, though. It's just the beginning of a new chapter. The company now has access to a vast pool of capital, but it also faces increased scrutiny from investors and regulators. It's a whole new ball game.